Why investing in index funds beats stock picking. What if someone told you that the best way to build wealth doesn't involve picking the right stocks, timing the market, or following complicated trading strategies? What if the smartest move is actually to do less and let time and consistency do the heavy lifting? That's the philosophy behind J.L. Collins' The Simple Path to Wealth. His message is clear. You don't need to be a financial genius to get rich. You just need to understand a few key principles. Save more than you spend, invest regularly in low-cost index funds, and stay invested no matter what the market does. Even Warren Buffett agrees. He famously said that when he's gone, he wants 90% of his money in a simple S&P 500 index fund and 10% in bonds. If the world's most successful investor trusts this strategy, maybe it's worth paying attention to. Most people, however, still try to beat the market, and most fail. Studies show that more than 80% of professional investors underperform the very market they're trying to outsmart. J.L. Collins calls this out as noise and distraction. His approach strips investing down to what actually works: simplicity, patience, and trust in the market's long-term growth. In this video, we'll explore why index funds consistently outperform stock pickers, how diversification protects your wealth, and how simple, repeatable investing can lead you to real financial independence. Let's dive in and explore J.L. Collins' core argument. 1. The myth of stock picking. We've all heard the dream. Find the next apple, buy early, hold tight, and retire rich. It's exciting. The idea that you can outsmart the market and strike gold with one perfect stock pick. Movies and headlines make it look simple, like all you need is intuition and courage. But here's the reality. That belief is one of the biggest traps in investing. Stock picking plays on emotion, the thrill of control, the rush of risk, and the pride of being right. It feels powerful to choose a company and say, I saw it before everyone else did. The problem? The numbers don't back it up. Study after study shows that 80 to 90% of professional investors underperform the market over time. These are people with advanced degrees, expensive data tools, and full research teams. And most still lose to a plain, low-cost index fund that just tracks the market average. So if the pros can't consistently win, what are the odds that a regular investor scrolling through a trading app will? Pretty slim. The truth is, stock picking often rewards luck, not skill. For every person bragging about buying Tesla or Nvidia early, there are thousands quietly nursing losses on forgotten sure things. We rarely hear those stories because failure doesn't trend, but it is far more common. Think back to the dot-com bubble. Investors threw money at anything ending with O and com, convinced the internet would make them rich. It did, but mostly for those who owned the broad market, not the hype stocks. The same pattern played out in the 2008 housing crash, the 2020 meme stock craze, and the countless fads in between. Each time, people believed this was the shortcut to wealth. Each time, most ended up disappointed. Why do we keep doing it? Because stock picking feels good. It feeds the ego, the sense that we're smarter than the crowd. When a stock rises, we call it skill. When it falls, we blame bad luck. That illusion of control keeps people chasing hot tips and trading more, even when history proves that patience wins. The finance industry fuels this behavior because it profits from activity. Every trade, every fund switch, every burst of excitement generates fees. Brokerage apps gamify the process, turning investing into entertainment. But true wealth doesn't come from constant motion. It comes from steady ownership and time in the market. J.L. Collins and Warren Buffett both teach the same lesson. You don't have to beat the market to build wealth. You just have to join it. When you invest in an index fund, you automatically own pieces of hundreds or thousands of companies. You're not gambling on one winner. You're investing in the success of the entire economy. The losers fall away, the winners rise, and you ride the average upward trend that has defined markets for generations. That may sound boring, and it is, but boring works. The most powerful investment strategies are simple, repeatable, and unemotional. They don't rely on predicting the future. They rely on the certainty that economies grow and markets recover. Stock picking promises excitement, but excitement isn't wealth. Wealth is quiet. It builds slowly, through consistency, not cleverness. It's the result of years of staying invested, reinvesting dividends, and letting compounding do its magic. So if stock picking doesn't work, if even the experts can't reliably beat the market, what's the smarter alternative? That's where we go next. The world of index funds, the simplest, most effective way to invest, and the strategy that turns patience into profit. 2. Understanding index funds. So now that we've seen why stock picking doesn't work for most people, let's talk about what does. Because if the goal isn't to find the next big winner, then what's the smarter path to wealth? J.L. Collins answers that question with 3 simple words: index fund investing. At its core, an index fund is a type of investment that doesn't try to beat the market. It matches it. Instead of guessing which companies will win or lose, an index fund simply buys them all. It tracks a specific market index like the S&P 500, which represents the 500 biggest companies in the United States. When those companies grow, you grow with them. When a few stumble, the winners pull you forward. Think of it like this. Buying an index fund is like owning a small piece of the entire economy. You're not betting on one company's success. You're betting on humanity's progress. As long as businesses keep creating, innovating, and growing, your investment rises with them. That's what makes index funds so powerful. They quietly take advantage of something called broad diversification. Instead of putting all your eggs in one basket, you're spreading your money across hundreds, sometimes thousands, of companies. So even if one stock crashes, it barely makes a dent. You're protected by the strength of the collective. J.L. Collins calls index funds the ultimate wealth building machine because they remove the guesswork. You don't need to predict the future or constantly monitor financial news. You simply buy the fund, keep adding to it, and let time and compounding do the rest. Now, let's talk about one of the biggest advantages: cost. Traditional mutual funds and active managers charge high fees for trying to outperform the market, sometimes 1% or more every year. That might sound small, but over decades, those fees can eat away tens or even hundreds of thousands of dollars from your returns. Index funds, on the other hand, are cheap, really cheap. Because they don't need analysts or expensive research teams, their expense ratios can be as low as 0.03%. That difference compounds over time, meaning more of your money stays invested and keeps working for you. It's a small detail that makes a massive difference. As J.L. Collins says, you can't control the market, but you can control your costs. And the lower your costs, the higher your long-term returns. Another key feature of index funds is their simplicity. Investing shouldn't feel like gambling or guesswork. It should be boring, predictable, and automatic. Index funds make that possible. You don't have to constantly buy and sell. You don't need to track performance charts every morning. You just invest consistently, month after month, and let compounding handle the rest. Warren Buffett has been preaching this for decades. In fact, he once made a famous bet with a group of hedge fund managers. Buffett wagered that over 10 years, a simple S&P 500 index fund would outperform their high-fee, actively managed portfolios. The pros accepted the challenge, confident they'd crush him. 10 years later, the results were in, and Buffett's index fund won easily. It beat nearly every hedge fund in the bet by a wide margin, proving that even the smartest minds on Wall Street rarely beat the market long term. So what exactly makes index funds outperform so consistently? It comes down to three things: diversification, cost, and time. Diversification spreads your risk, cost keeps more of your returns in your pocket, and time. Well, time does the magic. The longer you stay invested, the more compounding multiplies your money. Compounding is simple but extraordinary. When your investments earn returns, those returns begin to earn their own returns. Over decades, that exponential growth can turn modest savings into real wealth. Let's put it in perspective. Imagine you invest $500 a month into an index fund that averages a 7% annual return. Another benefit of index funds is how they remove emotion from investing. When you hold individual stocks, it's easy to get anxious. You see one company struggling and feel pressure to sell. You read a headline about a crash and panic kicks in. But with index funds, your mindset changes. You're not focused on daily ups and downs. You're focused on the long game. You understand that downturns are temporary and that markets over time always recover. That's exactly what J.L. Collins teaches. Markets go up, markets go down, but historically, they've always gone up more than they've gone down. Every crash has been followed by a recovery, and every recovery has set new highs. As long as you stay invested, you capture those gains. The only people who lose permanently are the ones who panic and sell. Index funds also make it easy to stay diversified across industries and even countries. For example, a global index fund can include companies from the US, Europe, Asia, and emerging markets, spreading your exposure worldwide. If one region struggles, others can balance it out. You're investing in the entire planet's productivity. Of course, no investment is risk-free. Index funds will rise and fall with the market. You'll experience volatility, especially in the short term. But unlike speculative assets or trendy stocks, the risk of total loss is extremely low. The market might dip for months or even a few years, but it has always recovered stronger in the long run. That's why Collins calls the index fund strategy the simple path, because it replaces stress with strategy. It's not about reacting, it's about trusting the process. He often summarizes it this way: spend less than you earn, invest the difference in low-cost index funds, and avoid debt. Do that consistently, and financial independence stops being a dream. It becomes inevitable. And here's another thing that makes index funds great: they free up your time. Instead of spending hours researching companies or worrying about trends, you can focus on living your life. The money works quietly in the background, growing with every passing year. For many people, that peace of mind is priceless. You know your portfolio represents the entire market, and as long as humanity keeps moving forward, your wealth does too. So, to recap, index funds work because they're simple, diversified, low cost, and aligned with long-term human progress. They don't rely on luck or timing. They rely on math, time, and patience. And if this approach sounds too boring to be true, that's the point. The best investing strategy isn't the most exciting one. It's the one you can stick with through every market condition. 3. Why index funds outperform most investors. So now that we understand what index funds are and how they work, the next question is, why do they actually beat most investors, including the professionals? How can something so simple outperform complex data-driven strategies used by people with decades of experience and billions under management? The answer lies in a combination of math, behavior, and cost. 3 areas where most investors quietly sabotage themselves. Let's start with fees. Every time you buy into a managed fund or trade actively, you pay a price. It might be a management fee, transaction cost, or even a hidden commission built into the fund structure. It doesn't seem like much, maybe 1 or 2% a year. But over time, those small percentages compound against you. Imagine 2 investors. One chooses a typical active fund charging 1% in annual fees. The other invests in a low-cost index fund charging just 0.05%. Both earn 8% before fees. After 30 years, the difference isn't small, it's huge. The index fund investor ends up with roughly 25% more money just because of lower costs. J.L. Collins puts it simply, performance is uncertain, fees are guaranteed. You can't predict what the market will do, but you can control what you pay. And the less you pay, the more you keep. That single difference explains a big part of why index funds outperform so consistently. But cost isn't the only reason. The second, and arguably more powerful, reason is behavior. Human beings are emotional creatures. We make decisions based on fear, excitement, and the desire to feel in control. The market, however, doesn't care how we feel. It goes up, it goes down, and it often tests our patience. When stocks rise, people feel confident and buy more, often near the top. When stocks fall, panic kicks in and they sell, often near the bottom. This buy high, sell low behavior destroys returns. Studies show that the average investor consistently earns less than the market itself, not because the market fails them, but because they fail to stay invested. Index funds take emotion out of the equation. When you invest in one, you're not reacting to individual companies or short-term headlines. You're owning the whole market and committing to ride out the ups and downs. You don't need to guess when to enter or exit. You just keep investing on a schedule. That consistency is what builds wealth. Time in the market always beats timing the market. Warren Buffett proved this when he made his famous 10-year bet against a group of hedge fund managers. He invested $1 million in a simple S&P 500 index fund, while the hedge funds used complex strategies, constant trading, and high fees. 10 years later, Buffett's fund returned about 125%. The hedge funds averaged less than 40%. The simple approach crushed the complicated one. And it wasn't luck, it was structure. Buffett's index fund had lower fees, no emotional trading, and full exposure to the long-term growth of the economy. The hedge funds, on the other hand, were burdened by costs, timing errors, and overconfidence. That story perfectly illustrates what J.L. Collins teaches. The more you try to beat the market, the more likely you are to lose to it. Another advantage of index funds is that they remove the need for prediction. Active investors are constantly trying to answer impossible questions. Which sector will boom next? Should I buy now or wait? Is this stock overvalued? The truth is, nobody knows. Markets react to millions of variables, from global politics to consumer mood to technological innovation. Predicting all that is impossible. Index funds skip the guessing game entirely. Instead of trying to predict which companies will grow, you simply accept that some of them always will. The winners lift the whole market, and you automatically own them by default. You're guaranteed to capture the average, and that average, historically, has beaten almost everyone trying to do better. Now let's talk about compounding, the quiet force behind long-term outperformance. When your index fund earns returns, those returns generate more returns. It's a snowball effect that accelerates over time. The earlier you start and the longer you stay invested, the bigger that snowball becomes. Most active investors interrupt that process by constantly trading, realizing short-term gains, paying taxes, and losing out on the exponential power of compounding. Index investors do the opposite. They stay still and let time do the work. As J.L. Collins says, the market always goes up. Not every day, not every year, but always over time. Here's what that looks like. If you invested $10,000 in the S&P 500 in 1980 and left it alone, no trading, no panic selling, it would be worth over $900,000 today, even after multiple crashes and recessions. The key wasn't timing, it was patience. Behavioral finance experts call this the investor gap. It's the difference between what the market returns and what investors actually earn. The market might average 8% a year, but the average investor only earns around 5%, simply because of bad timing, emotional decisions, and higher fees. Index funds close that gap by removing the temptation to act impulsively. And here's something else. Index funds make you an owner, not a gambler. When you own a diversified fund, you're a shareholder in hundreds or even thousands of real businesses, companies that employ people, create products, and drive economic growth. Every time you invest, you're participating in that growth. Over decades, that ownership compounds into real wealth. Compare that to the constant stress of active trading, watching charts, checking news alerts, second-guessing your moves. Most traders burn out or lose interest because it feels like work. Index investors, on the other hand, set it and forget it. Their money grows quietly while they live their lives. Another overlooked reason index funds win is tax efficiency. Because they trade far less frequently, they generate fewer taxable events. Active funds, constantly buying and selling, trigger more capital gains taxes that eat into your profits. The index investor keeps more of what they earn, legally and effortlessly. When you combine all these factors, lower fees, better behavior, compounding, diversification, and tax efficiency, the outcome becomes almost inevitable. Index funds outperform most investors not by chance, but by design. Now, that doesn't mean they're perfect. There will be years when markets drop, when it feels like your money is shrinking, and when you'll question the strategy. That's normal. But history has shown that the market always rewards patience. Every downturn has been followed by an even stronger recovery. Those who stay invested capture the rebound. Those who jump ship lock in their losses. J.L. Collins often compares it to planting a tree. You don't dig it up every few months to check if the roots are growing. You water it, give it time, and let nature do its thing. Index investing works the same way. Growth is slow, sometimes invisible, but always happening. And perhaps the most powerful part of all is freedom. Index funds free you from the pressure of needing to be right. You don't have to compete, chase, or predict. You just have to stay. Over time, the market rewards the calm, not the clever. So, to sum it up, index funds outperform because they keep costs low, minimize emotional mistakes, harness compounding, and give you broad exposure to long-term market growth. They're built for the average investor, but they quietly beat the vast majority of professionals too. 4. The psychology behind winning investors. When it comes to investing, intelligence helps, but psychology decides everything. The truth is, your mind will make or break your portfolio long before the market ever does. Most people imagine that successful investors are math geniuses, data analysts, or people with inside knowledge. In reality, the best investors are the ones who've learned to master their emotions. They don't react to fear, excitement, or noise. They follow a plan and stick to it even when the world feels uncertain. Let's be honest. Money is emotional. Watching your savings rise and fall on a screen can trigger the same parts of the brain that respond to fear and survival. When markets rise, we feel unstoppable. When they crash, we feel panic. Those emotional swings push people into bad decisions, buying when everyone else is euphoric and selling when everyone else is terrified. Behavioral economists have studied this for decades. They call it loss aversion, the idea that losing money hurts twice as much as gaining money feels good. That pain drives people to act impulsively, even when logic says, stay calm. We see the red numbers and instantly feel like something must be done. But here's the twist. The investors who do nothing usually end up wealthier than those who constantly react. History shows it again and again. The market rewards patience, not panic. Every major crash, from the Great Depression to 2008 to 2020, eventually gave way to recovery and record highs. Those who stayed invested not only recovered, but often doubled or tripled their wealth. Those who sold in fear locked in losses that never came back. J.L. Collins calls this the Zen of investing. The idea is simple. Once you've chosen your investments, your biggest job is to stay out of your own way. You don't need to check your portfolio daily or watch the news for clues. You simply need faith in the long game. This is where mindset becomes more important than market timing. Take Warren Buffett, for example. He's famous for saying that the stock market is a device for transferring money from the impatient to the patient. That statement isn't about intelligence, it's about temperament. Buffett isn't successful because he predicts every twist of the economy. He's successful because he never lets emotion dictate his actions. Think of how investors behave during a downturn. The headlines scream disaster. Analysts argue on TV about whether this is the next crash. Social media fills with panic. And in the middle of all that noise, a calm investor, someone following Collins' simple path, keeps investing the same amount every month. While others freeze or sell, they quietly buy at lower prices. When the market recovers, those shares explode in value. It's not luck, it's discipline. The hardest part of investing is now to understanding the system. It is staying calm inside it. Your brain is wired to avoid pain, so it wants to do something when the market dips. But most of the time, that something is exactly what hurts you. Acting out of fear turns temporary losses into permanent ones. The same psychology works in the other direction too. When markets soar, greed takes over. People start believing the good times will never end. They pour in money, take on debt, and start thinking they found a shortcut to wealth. Then reality hits, the bubble pops, prices fall, and emotions flip from euphoria to despair. The winning investors understand that both emotions, fear and greed, are dangerous. They accept that markets rise and fall like tides. You can't control the tide, but you can control how you ride it. You can panic and jump off the boat every time the water moves, or you can stay steady and keep rowing forward. One of the most powerful habits successful investors develop is emotional distance. They treat investing as a long-term project, not a daily drama. They automate their contributions, ignore the noise, and focus on time, not timing. This detachment protects them from impulsive decisions. J.L. Collins often reminds readers that the market is like a roller coaster. You only get hurt if you jump off mid-ride. The ups and downs are part of the experience. When you accept that volatility isn't a problem but a feature, you stop fearing it. You start seeing downturns as sales, opportunities to buy more shares for less. Another crucial mindset shift is redefining what wealth means. Many people think wealth is about quick gains or big wins, but real wealth is about freedom, the ability to live life on your terms without financial stress. The simple path isn't built for thrills, it's built for peace of mind. And that peace only comes when you stop letting short-term emotions control long-term goals. The best investors learn to find comfort in boredom. They know that slow and steady works. They don't need excitement from their investments. They get excitement from their lives. They let their portfolio grow quietly in the background while they focus on things that actually matter. Their families, their health, their passions. That's what separates investors from gamblers. Gamblers chase adrenaline. Investors chase stability. There's also a concept known as confirmation bias, where we only believe information that supports our existing opinions. If we think a stock will rise, we ignore bad news. If we think a crash is coming, we overreact to every negative headline. This bias tricks even experienced investors into making irrational choices. Recognizing it and deliberately stepping back is a sign of maturity in investing. And then there's herd behavior, the tendency to follow the crowd. When everyone is buying, it feels safe to join. When everyone is selling, it feels smart to run. But markets are paradoxical. When it feels safest to invest, prices are usually high. When it feels scariest, prices are low and opportunities are greatest. The winning investor learns to think independently, to act on logic, not emotion. J.L. Collins often uses humor to make this point. He says, "The market always goes up, but not in a straight line. It's like a drunk stumbling uphill. There are dips, stumbles, and moments of chaos, but the general direction is always higher." Understanding that image helps investors stay patient through rough patches. To become a winning investor, you have to shift from a short-term mindset to a long-term one. Instead of asking, "What will the market do this month?" ask, "What will it do in 20 years?" When you zoom out, the noise fades and the pattern becomes clear. Growth, recovery, and progress. The final psychological trait successful investors share is humility. They accept that they can't control the market. They don't pretend to know where it's heading next week or next year. That humility keeps them grounded, prevents overconfidence, and keeps them invested through every cycle. So, what's the takeaway? Winning in investing isn't about predicting, reacting, or outsmarting others. It's about mastering yourself. It's about patience when others panic, restraint when others rush, and faith when the world feels uncertain. If you can do that, if you can stay calm, consistent, and humble, the market will reward you in time. Because the truth is simple. In the long run, success belongs not to the smartest investor, but to the most disciplined one. 5. Building your own simple path. Up to this point, we've talked about why stock picking fails, why index funds work, and why mindset matters more than market timing. Now let's put it all together and build your simple path. A clear, step-by-step approach to reaching financial independence. The first step is simple but powerful. Spend less than you earn. It sounds basic, almost boring, but it's the cornerstone of wealth. Every dollar you keep is a soldier working for you, while every dollar you spend is one that never comes back. You don't need to live like a monk, you just need a gap. Money left over after your expenses. Because that gap is what fuels your investments. The bigger the gap, the faster you build freedom. Once you've created that space, step 2 is to eliminate high interest debt. Debt feels normal because everyone has it, but it's the silent tax on your future. Paying off a 20% credit card balance is the same as earning a guaranteed 20% return, something no investment can promise. J.L. Collins is clear on this. Before you grow wealth, you must stop the leaks. Step 3 is to build an emergency fund. Life throws curveballs. Layoffs, car repairs, sudden medical bills. Having 3 to 6 months of expenses tucked away protects you from panic and keeps you from selling investments when times get tough. It's your financial safety net, the buffer between calm and chaos. With your foundation steady, step 4 is to start investing. This is where your money begins to multiply. Collins's advice is refreshingly direct. Invest in broad market, low-cost index funds and leave them alone. That's it. You don't need fancy funds or insider tips. A single index fund like VTSX or an ETF like VTI gives you ownership in thousands of companies across every industry. Instead of betting on one winner, you're betting on the entire economy. And history shows that bet always pays off in the long run. Automate it. Set up a recurring investment that transfers money into your account every month without you thinking about it. Automation removes emotion. You invest whether the market is high, low, or flat. Because time, not timing, creates wealth. Next, think about asset allocation. How much you hold in stocks versus bonds. Stocks drive growth, bonds add stability. Younger investors can afford more stocks because time cushions volatility. As you age, you might shift gradually toward bonds to preserve what you've built. The goal isn't to chase the highest return, it's to create a mix that lets you sleep at night. And then comes the golden rule: stay invested. The market will crash, not once, but many times. Every dip will tempt you to run. Don't. The market has fallen before, and it has always recovered stronger than before. Those who stay invested capture the rebound. Those who panic lock in losses. Collins reminds us that the market always goes up, eventually. Patience turns downturns into opportunity. That's the heart of compounding, the most powerful force in finance. When your investments earn returns, those returns begin earning their own returns. At first, progress feels slow, and one day, the curve starts bending upward and your money grows faster than you can save. 10 years feels steady, 20 years feels impressive, 30 years feels unstoppable. To protect that growth, aim for tax efficiency. Use retirement or investment accounts that shelter your gains. The less you pay in taxes and fees, the more your returns can compound. Even in regular accounts, index funds naturally generate fewer taxable events because they trade less often. They grow quietly without drawing attention or tax bills. But the real beauty of this path isn't just the numbers, it's the peace of mind that comes with it. While most people stress over market swings or chase the next hot stock, you'll have a calm, automated system building wealth in the background. You won't need to check the news or time your entries. You'll know that every month, your future is quietly getting stronger. As your portfolio grows, you'll reach a turning point when your investments start working harder than you do. That's what Collins calls FU money. It's not about arrogance, it's about freedom. It's the power to walk away from a job you hate, take time off, or say no to something that doesn't align with your values. It's knowing you have enough to choose your life, not just endure it. How much is enough? Collins offers a simple guideline: your financial independence number. Charge 25 times your annual expenses. If you spend $40,000 a year, aim for a portfolio of around $1 million. That amount, invested in index funds, can safely generate what you need to live indefinitely through the so-called 4% rule. Getting there isn't about luck or timing, it's about consistency. Follow this sequence: spend less than you earn, build an emergency fund, stay invested for decades. No shortcuts, no secrets. And here's the best part: you can tailor it to your own life. You can start small, pause when necessary, and scale up when ready. Every contribution counts. Every dollar invested is a brick in the foundation of your independence. Along the way, remember what the goal really is. It's not about having the biggest number in your account. It's about what that number allows you to do. Freedom to work because you want to, not because you have to. Freedom to spend time with family, travel, create, rest. Money itself isn't the destination, it's the vehicle. So if you've ever felt overwhelmed by financial advice, remember this: your path doesn't have to be complicated. It just has to be consistent. Spend less than you earn. Invest the rest. Stay the course. That's it. J.L. Collins wrote The Simple Path to Wealth for his daughter, but its wisdom applies to everyone: students, workers, parents, retirees. The message is timeless. Wealth is built by ordinary people who make calm, steady choices for a long time. When you follow this path, something changes. The noise fades, the stress disappears, you stop chasing the market and start living your life. Because real wealth isn't measured in dollars. It's measured in time, peace, and control over how you spend your days. So start today. Save something, invest something, trust the process, and let time do the rest. That's the simple path. And it's the surest one to freedom.